What's up, guys? So we're back with step 2 of the 6 steps to financial independence, and today I am talking about debt management, aka the cost benefit of borrowing. We live in an absolutely debt-laden society. It is an epidemic in this country, and to a large degree our economy actually relies on debt to keep it rolling. If everyone were to suddenly get rid of all of their debt, the economy would go into an immediate downturn. The debt industry is a multi-trillion-dollar industry, but that does not mean you need to become a victim of debt. So many clients that we sit down with, they understand the value of saving for the future. They understand the value of investing and growing their money to get towards financial independence, but they're truly living paycheck to paycheck. As soon as they're done paying everybody else, there is no money left over to pay themselves. You got 15 bills against 2 checks. Who's going to win? I think we know. So when the issue is high liabilities and heavy debt burden, there are 3 solutions that we can suggest. The first suggestion is to consolidate that debt. So we're going to go and we're going to get a personal loan, something of that nature, and we're going to use that lump sum with friendlier repayment terms, a lower interest rate, to go and knock out all of our existing high interest credit card debt. Now we only have 1 bill to pay with friendlier terms, and that's going to save a ton of money on interest payments over time. What I like to call throwing money into the ocean. You're just paying interest. The balance never gets smaller, even when you're not putting any new purchases on the card. The second suggestion is to settle the debt. Now this is for somebody who is truly up to their ears, someone who is truly drowning, and they just need some relief from the pressure. They need to knock down that total debt burden. Things have just gotten out of hand. So we have a partnership with a company called Debt America that's going to negotiate with your creditors to have your total debt lowered, easing that monthly burden and freeing up some discretionary income so you can breathe and pay yourself. Now, there is a catch. It's going to temporarily drop your credit score for approximately 8 to 12 months. So if you're planning on financing a vehicle, on purchasing a home, that may not be the best option for you in the immediate interim. The third suggestion is to eliminate that debt. So this is going to be for folks who have a little bit of a higher income, or the debt is still manageable. We just need an efficient, strategic way to repay that debt to save as much on interest as possible. So that strategic repayment could be something like the snowball method. You've heard of that before, where you systematically pay one debt at a time and use the money from the repaid debt to pay off the next debt, so on and so forth. So those are the 3 solutions that we can suggest for helping lower the debt. Now, what I want to talk about next is the difference between good debt and bad debt. So over here we have our good debts. Now there are ways to use debt responsibly and strategically, and that's to finance appreciating assets or investments. So these are things that are going to produce cash flow or accrue value over time. You go into debt temporarily, but you use that debt to go ahead and make some money. So this is something like a business loan to expand your operations. You go into temporary debt, but now we've expanded our business, we're bringing more profits in. Not only are we going to pay for that debt, now we have some money going into our pockets. Or something like a rental property, where you go into debt to purchase the property, but the cash flow produced by that property is going to cover the debt and put money in your pockets where you want it. Another good debt is investment in education or self-improvement. So I call this making yourself into an appreciating asset. And if you can do that, you're in a very good position. So this is something like investing in college education, in training, in certifications, in seminars, courses, things that are going to get you in a better position to make more money and pay for themselves over time. Now over here we have our bad debts in red. Bad. Depreciating assets. So the number 1 depreciating asset that people finance and get into debt for are cars. This is commonplace in our country, it happens all the time. That new car that you just went into debt to purchase is going to lose 20% of its value the second you leave the dealership, and then approximately 10% annually for about 5 years after that. So if you have that car for 5 years, it's probably lost about 80% of its initial value. Now, if you're going to have the car for 10, 15 years, it's going to be paid in full, you're not going to be stuck paying interest forever, then it doesn't really matter about the depreciation. The resale value is not of that great a concern because you are going to use the car until it's pretty much used up, and whatever it's worth is no big deal. But if you're somebody who's constantly leasing cars, leasing new cars, year after year, every 3 years, you need to get a new car, you're constantly going to be hemorrhaging money, paying interest forever, and when you trade that car in, you're going to get half the value that you paid for. Consumer goods as well, stuff like electronics that become obsolete very quickly. They lose their value as soon as they can be called used, even if they're still in good condition. Second area is using credit cards for lifestyle wants. So these are discretionary stuff, basically. Buying things that you don't really need with money that you don't really have. The money to pay for it doesn't exist. Now, there are savvy ways to use credit cards. If you have the money in the bank, if you're going to pay it off at the end of the month, that's great. You're building credit. Maybe you're getting some rewards or some points. You can redeem those for trips or for gift cards, whatever the case may be. Sometimes people use those cash back cards in very strategic and savvy ways, and if you're doing that, that's not a problem. But if you're using pretend money to pay for stuff you don't need, that is a problem. And now the third one is credit cards to pay for credit cards. Whew. That is a cardinal sin, and I think it should go without saying, you shouldn't be using pretend money to pay for the debt that is pretend money. You're just compounding a bad situation. You should never ever be paying off credit cards with other credit cards. You're literally just robbing Peter to pay Paul, and it's going to catch up to you eventually. Now, at the bottom here, we have this cute little house. So this is a major debate. Is my home a good investment or a bad investment? Some people say, oh, my home is my biggest asset. That's my most valuable asset. Of course, it's a great investment. And some people say, no, you should rent. A home is just going to cost you money in the long term. It can go both ways. So if your home is in a great location, the home itself you improved, or the land is worth a lot of money, and that asset is going to appreciate over time, you're going to be able to sell that home for more than what you paid for, then yes, it is a good investment. However, we saw in the 2008 housing bubble that many people took big losses on their homes. They sold them for less than what they paid for, and in that case, it can be a bad investment. So when it comes to your home, it really depends. So, I hope this breakdown assisted you in keeping some things in mind if you have a debt issue that you need to get out of, or you're wondering if you're using debt responsibly and in a savvy manner. So stay tuned. We have step 3 of the 6 steps of financial independence coming soon. Take care.